All right. Today is Thursday, February 6th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. In tonight's program, we're going to talk about the jobs report coming out tomorrow, a little bit of a preview for you, but most importantly, the new administration's effort to cut government jobs. How would that impact the unemployment picture and the pace of job creation that was hot in the year 24? And then we're going to talk about the Bank of England, which came out with a little bit of a alarming forecast about stagflation. And of course, we finished with Amazon's earnings, because there's an important thing you need to pay attention to here. You're not going to hear it from any other channel. So stay tuned, folks, and let's begin right away with the breaking news that we got after the bell. Here is Steve Leisman from CNBC.
Well, let's say, CNBC has learned that many economic data sets from census.gov are now not available to the public. Census.gov website, when you call up normal data sets like how many people live in the country, population estimates, says access to the data is, quote, forbidden. Some data experts have found a workaround for some of these data sets, including going to another website, data.census.gov, but it's not all there and not all easy to do. Data normally downloaded by economists is just not there, according to several sources we've talked to. For example, Maureen Haver at Haver Analytics, who provides data to CNBC, says, my staff tried numerous economic releases and we could not access them through census.gov. Mike Horrigan, president of the Upjohn Institute for Employment Research, says, when was the last time that Census just stopped publishing data? That just doesn't happen. It suggests that there may be internal pressures not to publish data that we rely on, and we need to figure out if that's true. It is unclear if this census data is a technical problem or part of a larger federal data purge that we've seen in things like healthcare and other areas of the government. We emailed the Census Bureau. We called them. They could not be reached for comment in the last several hours. Melissa, just very quickly, Census does provide data for the household survey that the BLS releases tomorrow. I have no indication that there will be any problem with that data tomorrow. But obviously, economists are concerned about this data, and it is used widely throughout the economy. Another bit of data that's not available is tiger mapping data that's used widely in mapping programs like Google and all sorts of things. Those files are also unavailable at this time, we understand.
All right. Steve, do you know if this data is unavailable or if it has been deleted?
I do not know that. I know that when you go to access these files, it says forbidden.
Now, I'm not sure what the deal is all about from banning the data coming out of the census, which we have a lot of economic data comes out of the census that we rely on. So this is really weird. I'm not sure about the reasoning behind it, but the word forbidden, it sounds like a tyrannical regime took over. I mean, what is this? China, Cuba? What is this? Forbidden? Economic data forbidden? Are you going to start cooking the data now? What's going to happen? I mean, the data's already cooked, so what's there left to cook? But we'll see what happens. This is really weird, and a lot of tinfoil hat theories will come out of it. We'll wait for more clarity, but luckily for us, tomorrow's data comes out from the BLS, aka the kitchen. And of course, we can talk about what to expect, what not to expect. In my opinion, the report tomorrow is not going to be really that important because we're not going to see the impact of the decisions that the new administration took until the next report. But in this report, we'll get some, at least, trends about the issue of inflation and weakness in some sectors. Right now, of course, the market is getting a little bit excited because maybe the picture of inflation, according to the services PMI and ISMs that we got yesterday, maybe it is cooling a little bit. And therefore, we've seen bond yields going down. That's the good news for the market. It could be bad news if the employment data tomorrow comes out hot, because that's going to suggest that perhaps the Federal Reserve needs to pause for longer. Now, of course, also alarming if the jobs data comes out way weaker than expectations, because that's going to fuel recession kind of fears. And when we have recession fears, the market tends to overreact to the downside. I don't expect a major outlier here, to be honest with you. The sweet spot, of course, is plain vanilla, where you give us the number as expected. No major outliers up and down, both in the headline number or the wage inflation number. But of course, as we know, the devil is always in the details. We have to look at the household surveys. So that's going to be even more important than what happens with the actual data. Not to mention, of course, we might get some revisions of previous data, so a lot of things to take into consideration. Now, what's important to me is what will the trend look like in the year 2025? Because if you look at the year 24, all in all, it was a weaker year, to be honest with you, in the pace of job creation. What made it hot? 3 sectors. You got healthcare, of course, on top, and we talked about this numerous times last year, that we're an aging country and we have a huge void in healthcare and social assistance to the senior community. But that's going to continue to be here, even in the year 2025, recession, no recession, doesn't matter. At the end of the day, you still need employees, and the majority of the spending in the healthcare sector and the social assistance comes from the government, so I don't expect any slowdown in that sector. Maybe it's going to be a little bit, if there is a recession, it'll slow down a little bit, but it'll be more resilient than other sectors in the economy. Now, here's the catch. In the year 2024, the government created over 440,000 jobs. Now, we know why. The Biden administration wanted to manipulate the numbers because they knew that the employment numbers are not really that good. And the easiest way to do so is just create fake government jobs. The problem now becomes the efficiency endeavor that the new administration has taken on, which is we got to reduce headcount in the government. So we'll talk about that in a minute, but we have leisure and hospitality. We know that that's tied to the stock market. Why? Because the leisure and hospitality sector have been really hot, only because of the affluent consumer spending in the economy based on the confidence of higher stock market, aka the wealth effect. Construction, of course, a lot of government spending, a lot of welfare to huge technology companies to build factories here, so we see construction moving higher. Not to mention, of course, there are a lot of home builders been building a lot of homes to mitigate the housing supply shortage. The problem with the construction sector is the following. Maybe the Trump administration will continue to build and spend in government spending and construction, got it. But when it comes to the housing sector, we know that demand is slowing down because of higher rates and inflation been going on in the economy for a while, so we see damage in the ability of the consumer to spend. They're dipping into their savings that were intended to buy a home. So we're going to see a slowdown by the home builders in the pace of construction. That leaves healthcare as an exception, got it. Leisure and hospitality depends on the stock market. Construction we expect to be lower than last year. And that brings the issue of the government sector. The Trump administration says we're going to reduce the number of employees in the U.S. government by 10%. Well, if you do that, look at the chart that I'm showing you right now. You're going to shave off at least 200, 300,000 jobs. You got to get rid of some of those jobs that we created last year, quote unquote created. Nothing was really created, but anyways. So how would that impact the jobs data we're about to get from here on? How would that impact the unemployment picture? If you said negatively, you got it right. And if you said, okay, if the unemployment rate goes higher and the jobs data go down, then how do we square what you said before, Mav, that maybe the risk is for interest rates to go higher because of the revival of inflation? Maybe the Federal Reserve will begin to cut rates as we see the unemployment rate going higher. You got to keep in consideration the following. What the Trump administration is doing is getting rid of the excess. If there is legitimate economic weakness, then you'll see a legitimate deterioration in the job creation in the economy and the unemployment rate. Furthermore, the inflation risk is not mitigated yet. It's actually amplified by the tariffs, and we'll cover that in a minute when we talk about the Bank of England. But here's the bad news for you. We just talked about the healthcare sector being resilient and all of that. The Trump administration wants to hit that sector too. Here's the headline for you. White House preparing order to cut thousands of federal health workers. The executive order could come as soon as next week if the Trump administration goes ahead with the plans. Here's the magnitude of the damage. The job cuts under consideration would affect the Department of Health and Human Services, which employs more than 80,000 people and includes the National Institutes of Health and Centers for Medicare and Medicaid Services, in addition to the FDA and the CDC. The agencies are responsible for a range of functions, from approving new drugs to tracing bird flu out. Anyways, you know this bullshit. We all talked about this. At the end of the day, the CIA came out and said, the whole COVID thing came from a lab. So all of you conspiracy theorists who got banned from YouTube, you got it right. But we're never going to apologize. Anyways, the bottom line is, even the healthcare sector of the economy, which is the hottest one when it comes to jobs creation, will be under the efficiency endeavor by the new administration. You're putting two and two together, you're coming to the conclusion that jobs creation will be weaker and weaker as we continue to progress. Not to mention, of course, that also we got the buyout plans in many of the government agencies with thousands of workers. The latest number is 50,000 workers took the buyout plan. Now, today we got the breaking news that a judge halts the Trump government worker buyout plan. At the end of the day, this is going to be debated and it will be up to Congress, maybe at some point the Supreme Court if it gets really ugly. But my 2 cents is this is going to go through because it leaves you with the ability to choose. But at the end of the day, working from home, excess workers, they're going to be a target for the Trump administration. And it begins with the excess, and then little by little it begins to involve other workers, which will increase the unemployment rate and increase the odds for a recession. The problem is, odds of a recession, we can deal with that because the Fed can cut rates and stimulate. The problem is, what if we have the tariffs and we have a revival in inflation at the same time? Hence, a stagflationary phenomenon. Now, today in the morning, we got the Bank of England, and they issued a dire warning about budget worries in the United Kingdom and, of course, a stagflationary warning. This is Governor Bailey, who appears to be hitting the Ozempic pretty hard. But look at the change that we got from the BOE today. In the year 2024, the GDP was forecasted, this is for the UK, of course. GDP was a net growth of 0.9%. Now they downgraded that to only 0.7%. With that being said, the CPI, 2.4%, that's in November. Now they say it's going to be 2.5% in the latest forecast for the year 2024. And look at this. In the year 2025, the November GDP forecast by the BOE was that it's going to be up 1.5%. They've downgraded that to only 0.7%. That's a disaster. On the other hand, look at this. The November forecast for CPI was 2.7%. They have upgraded that to 3.5%. The combination of lowering the GDP forecast but upgrading the CPI forecast, again, put 2 and 2 together, you get stagflation. I don't know what you're going to say, but Mav, who cares about this mumbo jumbo? You got stagflation, higher unemployment, nobody cares. The market's just going to go higher. Be careful what you wish for, because even the companies are now beginning to forecast weakness in the economy. After the bell, we got the headline, Amazon issues disappointing revenue forecast, points to the weakest growth on record. Once again, points to the weakest growth on record. This is a very dangerous place to be in both the market and the economy. Now, I know a lot of analysts and YouTubers and even the channels, CNBC, Bloomberg, will come out and say, oh, the revenue was pretty good for Amazon. It was up so. The net income was higher. AWS, it doesn't matter. Nobody gives a fuck about revenue or net income or anything. All of that is looking pretty good. I can show you the data. It looks pretty good. Amazon is still growing. Sure, the weakest forecast got it. But the growth of sales is okay. North America sales is okay. AWS growth okay. What matters at the end of the day, and this is why I cut to the chase, I give you what really matters, what's going to impact the stock performance. And I showed you that in Meta, I showed you that in Google, I'll show you here in Amazon. What you're looking at right now is CapEx growth in white and operational income growth in yellow. When you have a deficit where CapEx growth exceeds the rate of growth of operational income, you get a negative stock performance. When you have the gap becoming positive, as we've seen in the year 23 and 24, where operational income growth exceeds the rate of growth in CapEx, we see positive returns in the stock. Now, Amazon already gave us the CapEx growth for the year 2025. It's closer to Microsoft at about $85 billion, which is kind of insanity, but we don't know the operational income growth. They did not give us the forecast for that, not even revenue growth. So you have Meta, you have Google, you have Amazon. All three companies, and by the way, Microsoft the same way. All four companies gave us the projection for CapEx growth, but no mention of revenue growth or net income growth. Gee, I wonder why. With that being said, there was an important mention here in Amazon's report. I'm highlighting it for you right here if you're looking at the screen right now. It reads, operational income is expected to be between 14 billion and 18 billion, compared with 15.3 billion in the first quarter. Well, first of all, if you say 14 to 18 billion, that is such a wide range you can fly a jumbo 747 in between. And it also projects uncertainty and perhaps some flaky and shady kind of projection by Amazon. Really, the quarter that already, we got a month out of it already gone. And you give it such a wide range like this, 14 to 18 billion, okay. I'm going to take them at the word and say I'm going to take the average between 14 and 18, 16 billion. That's going to give a rate of growth of about 4.5%. Let's assume that this rate of growth, this is a big assumption in my projection. Let's assume this rate of growth, 4.5%, 4.6% in operational income for the first quarter will be applicable to the rest of the year. If we do that, we go back to the chart, here it is. You're going to see that the operational income growth is going to begin to lag behind CapEx growth. In other words, it's going to result in negative stock performance in Amazon. If you don't believe me, here it is. We're going to plug this time around the stock growth in blue. Everything else stays the same. You can see that the stock growth was negative when we had a deficit. The moment they've reduced CapEx and concentrated on increasing the operational income, we've seen positive stock returns. The bigger the gap, the bigger the stock returns. The bigger the deficit, the lower the stock returns. Let's play with the forecast that I just gave you. What do you think will happen here in the performance of the stock? It's going to go negative. And right now it appears that it's going to be a negative 10 to 20% by the end of the year. There is an easy fix, of course. The easy fix is they got to stop spending like a drunken sailor. And maybe they're going to wake up to that fact, but I think they're going to wake up to that fact after the damage is already done, after their stock performances are down 10, 15%. They'll come out and say Google, Meta, Amazon, Microsoft, they'll come out and say, okay, we're going to reduce CapEx. I guess DeepSeek was right. We don't need to spend as much. And if that happens, you're going to see a positive gap between CapEx growth and operational income growth, and that's going to be positive for the stocks. But unless that happens, right now it appears that we're looking at a negative year for the big caps. And if it is a negative year for the big caps, what do you think will happen to the indices? And this is why a lot of portfolio managers, as I mentioned to you before, are now beginning to rotate their clients outside of the big caps, outside of the major indices, into alternative indices, such as when we talk about pension or retirement. You can't really sell or short. You got to stay long. And this is why I think that when all is said and done, the new generation of retirees will be absolutely devastated because they bought the market at bubble pricing and they will never see it in their lifetimes again. And that's, of course, going to hammer the inheritance for other generations. But that's a subject for another discussion. What matters right now is the portfolio managers are saying, okay, let's rotate to the equal weight. Let's rotate to value. Let's rotate more into fixed income. Let's rotate to gold. And I've been doing the same thing, by the way. I told you last year, rotated from the S&P all in the RSP, the equal weight, and GLD gold. Because I'm not trusting the big caps. I think they're going to run into this problem. And we talked about this, by the way. Last year, we warned everybody that at some point, we're going to run into this deficit where CapEx exceeds the rate of growth in these companies. They're going to run into the law of large numbers, and you'll see all of these stocks collapsing, the end of the bubble. And now we're beginning to sniff that happening. It's avoidable, as I said. They can cut CapEx, but I think we're going to get to a point where the damage is already done, and then they're going to respond. Keep that in mind. Let's talk about the morning brief really quickly here. Folks, today was a dull tape, and I kind of spotted it from the beginning of the day. I said, okay, this is going to be a really boring tape. And if you try to trade this kind of tape, you're going to be prone to make mistakes. Yesterday in the stream, I said the same thing. Dull tape, don't make mistakes. Don't react to the charts, the 1 minute chart and the 3 minutes chart and the tick by tick that a lot of you keep watching. You're going to make mistakes. When it looks dull, leave it alone. You don't need to trade that day. And so far this week, besides Monday, we didn't really have any opportunity for trading, to be honest with you. And this is why I didn't do anything Tuesday, didn't do anything Wednesday, didn't do anything today. And today I told you, I'm out. We're not going to even do the stream. We're not going to even do the chat with the exception of the closing hour. Because why bother? Why waste time? Go do something else today. And what you need to do is just have the assumption, this is what I gave you. The base assumption is we have a retracement all the way to the sloping line of resistance in the S&P. That's the assumption. Any failure at or before will be a problem. And of course, can be just, hey, we face the resistance, we find new buyers after a little pullback, and then we break above. But a failure before reaching the trend line that you see is problematic. But even if that happens, we're not going to act on it and initiate a new trade against the S&P, the so-called bazooka trade, mini bazooka is what I'm planning for right now. We're not going to initiate that until we lose the 50 days moving average. Why is that important? Because once we lose the 50 days moving average, you got a confirmation of a lower high in the pattern, and you're going to form a lower low, which could lead us all the way down to 5,900. And that will be the trade, by the way, 5,900, 5,800 put spread, and we'll do that for March and keep it to play the seasonality. But again, That's all I can give you right now in the morning brief. I'm not going to waste your time and tell you, hey, we got an opportunity to trade this and trade that. And then you find yourself stuck 4 or 5 hours just watching the chart going up and down within the same range. And then at the end of the day, the last hour, they give you a little bit of a trap or they flush it down aggressively, then bring it back aggressively. And the next day they drop it down. There's no reason to be involved when the tape is dull. When the volume is low like this, get the hell out. Do something else. But folks, a note for tomorrow. We're going to see a little bit more action. We're going to see if the volume coming back a little bit, OPEX, of course. So we're going to be active tomorrow. We're going to do the stream 7:30 right away. We'll do the chat right after. We're going to do 8:30, not 9:30, because I got an appointment at 10. And I want to wrap it up really quickly. Friday, of course, if there is any movement by the end of the day or there are any portfolio moves that I'm going to make, I'll share with you before the end of the day. And hopefully, fingers crossed, we're going to do a few more bonus videos in the weekend, including charts to watch, because we do them monthly. We finished the month of January. We'll probably do for another one. When we look at the weekly charts, anticipate where they're going to move and conduct trades based on them. So be in the lookout for that. Again, fingers crossed, we do that this weekend. But let's add more color to this conversation here, folks, by revisiting the market activities today, beginning with the closing of the indices. And here we go. The diamonds in the red, which is not a really good indicator, the bond market movement. Because you got to remember, this is sort of the defensive yield-sensitive ETF. So the Dow in the red, down by 125.65 points, or a loss of 0.28%. The Nasdaq in the green by 99.66 points, or a gain of 0.51%. I think the Nasdaq is being manipulated because somebody right now is manipulating NVIDIA higher. And you only need NVIDIA's weight to move the indices up. So we see the S&P also higher by 22.09 points, or a gain of 0.36%. By the way, when I say manipulation, I showed you in last night's program, I showed you the unusual activities in buying millions and millions of dollars of NVIDIA call options out of the money with the expiration dates in 26 just to move it higher. Then they dump it and they suck a bunch of buyers in, but they already cashed out. In, out, hello, goodbye. They're never going to hold till 26. Anyhow, the Russell 2000, another yield sensitive in the risk on segment though. Some argue it's a leading indicator, down in the red by 0.75 points, or loss, not a gain, loss of 0.33%. Looking at the daily performances, what do we see here? Financials on top. Look, financials is the kind of sector where we see in a dull tape where you have low volume and you're not really sure what's going to happen or where to allocate capital to. The asset managers by default go with the banks, especially JP Morgan. They just keep dumping money over there without any consideration or thinking at all in a tape like we got today. But we see metals higher, mostly in gold miners, by the way, because gold is going higher. Consumer defensives now catching a bid as we see yields going down, but we got to wait for the confirmation from the jobs data and the CPI next week to make sure that indeed interest rates, bond yields are going down. We see technology, thank you to NVIDIA, because a lot of technology was down today. At the bottom of the pack, there was a huge drop in energy. Yesterday, we talked about the price war, maybe a little bit of a fear about that. Folks are watching the program, and a lot of you are asking, what do I do with energy? Right? If there's a price war, it's going to be bad for energy. The truth is, yes, if there's a price war and lowering the pricing down, yeah, it's going to be ugly. But at the same time, I told you that the options are limited. You can bark and say, I want to lower energy prices, I'm going to increase the production and all of that. At the end of the day, the data will come out that it's going to take years to increase the production without the reliance on another foreign country to increase their own supplies. And the wild card, of course, is China. If China issues stimulus, then that's going to be a tailwind for oil. But right now, a little bit of a fear today. And healthcare down again. We have some earnings. We'll talk about that in a minute. Looking at the breadth all in all, at the neutral line, dull tape. You can't really play it. NYSE, 50% advancing, 49% declining. The NASDAQ, 44% advancing, 52% declining. So you see a negative breadth in the NASDAQ. With that being said, the index is higher. Thank you to what? One name blasting higher, that is NVIDIA. Moving on to the heat map, let's see what we got here. Obviously, NVIDIA was the top performer today. The rest of the big caps did okay, but they're lagging. And with Amazon after the bell down about 4%, you're probably going to see a negative reaction in Google, Meta, maybe Apple, Microsoft, although Apple is showing some signs of strength. Now, bear in mind that what we see in NVIDIA right now is just rotational in nature. It is not a vote for the chip stocks or sector altogether, because you see here, Qualcomm was bad, ARM was bad, AMD is still down. IBM is even pulling back, and the manufacturers not doing so hot so recently. Why do I say that NVIDIA is a rotation today? Because you see healthcare down. I mean, today in healthcare, we got Lilly. Okay, that's an earnings reaction. We got Bristol Myers. That's also another earnings reaction. But why do we see an inclusive sell-off here in healthcare? Go back to the heat map from Monday. NVIDIA was down big, and then who benefited? Healthcare as a rotation. Now the managers or wherever investors are, they're saying, okay, you know what? Maybe with the capex that we've seen from Amazon, from Google, from Meta, from Microsoft, they're not changing any of that. So why don't I just book some profits from the healthcare sectors and stocks that I bought Monday and rotate them back into NVIDIA? That's the idea right now. And of course, in a Dell tape, they're buying the banks. That's the safest bet. So we see financials higher, led by JP Morgan. Every time they don't know where they allocate the money, because you got to remember, every day you're getting millions and millions of dollars to allocate. If you don't know where to put them, if you're not going to chase NVIDIA, for example, because you think that's too much, you're going to pump them again in JP Morgan or any of the big banks that you see, including, by the way, some of the asset managers like Goldman Sachs, Morgan Stanley. But those are reactive to the performance of the indices. In other words, the performance of NVIDIA, which impact the indices the most. What do we do with the software sector here? Because yesterday I told you about that trade, the unusual trade that we got for CRM. And somebody knows something. Somebody who knows what's cooking in CRM. They bought the 320 puts yesterday with millions of dollars. And next thing you know, the CRM goes down by 5% based on cutting jobs. To me, that's an insider trade. But the rest of software, I think, is going to do okay. Of course, you have a pullback in Shopify today. It reported earnings. But I think we'll see, a comeback in software because this narrative right now of, oh, let's go back to NVIDIA, ain't going to last for too long. And then we're going to see a rotation back into software because that's the sector that benefits the most. It has the AI catalyst, it has the deep sea catalyst, it has the efficiency catalyst. And not to mention, of course, cybersecurity. We got Fortinet after the bell. That's doing pretty good. We got Net, Cloudflare. That's doing pretty good. So I expect cyber to continue to be hot. The rest of performances in the market remain mixed. So you see some stocks up here in engineering. We see some rebounds in industrials, but we see also pullbacks in Honeywell, which reported earnings. And we see Tesla down. That's going to be a problem. Ford reported earnings. That was not good. So we see it going down. Toyota, some of the gains from yesterday are being trimmed. But watch Tesla, because Tesla is showing a lot of weakness here. And I think it might snap at some point and begin to flush down. The Chinese names rebounding. Every time they sell them, they rebound. And the cyclicals, today we got Hilton. So we see the hotels doing pretty good. But the rest of the sector is kind of muted, with the exception of Nike. Nike not performing pretty good as of late. Something is cooking here against Nike. And maybe it adds up with perhaps the tariffs and fear by some investors about you got the tariffs against China and against the U.S. from China. And you also got a weakening consumer. So Nike's not in a good spot here. In the defensives, we see earnings from Hershey's with cocoa going down. That's going to be pretty good. And for Mondelez, same time. You got Philip Morris. That's hot. Tobacco's all of a sudden making a comeback. And don't forget, of course, if bond yields go down, tobacco's going to be hot. But besides that, folks, energy got absolutely clobbered today. And I think there is a degree of overreaction. I'm not sure what the news is because the futures were pretty much flattish, slightly negative for the day. So there was no reason for oil to sell like this. I think part of it, as we said with healthcare, Monday we've seen a rotation where NVIDIA was sold, energy was leading along with healthcare. I think they're just rotating all of those gains that they got from energy and healthcare in a short amount of time, all the way back to NVIDIA. And then lastly, we look at metals. What do we see here? Hot, still hot because the dollar is weakening a little bit, although it might be due for a rebound. But we see metals doing pretty good, materials, chemicals, copper, the building stuff. But agricultural stocks were down, maybe on the heels of the weakness from FMC tomorrow, or yesterday rather. FMC has reliance on China. We talked about that, but we see a lot of pullbacks here. Some of them are aggressive, and I would look at them as an opportunity to buy. In the fertilizers like Mosaic, like Nutrin, I would see that as an opportunity to buy so long as nat gas futures continue to go higher. And then you got Corteva. I think that's a solid name. Reported earnings yesterday, pulled back a little bit. I think we're going to get really, really close for an opportunity to add or buy Corteva. FMC, I'd avoid that because even if it rebounds, it'll be just an oversold rebound, but it would not be a reliable rebound because of the issue with China tariffs. Looking at the heat map for the ETFs, what do we see here? The TLT was flattish, so no major movement. In the IWM or any of the yield-sensitive stuff, they're flattish for the most part. But we see the KRE regional banks moving higher. Why? Because we've seen some flows into the financial sector in a dull tape. You just have to resort to the financials as a money manager. because what are you going to do? Either you chase NVIDIA or you go with the financials. Healthcare down, energy down. We talked about this, maybe pulled back in rotating the flows to the SMH or aka NVIDIA. But besides that, again, you see that the breadth is not good today. Dow Jones down, RSP down, dividends down, value down, mid caps down, and the majority of the gains came from one large cap, which is NVIDIA, because the XLK is flattish. So the majority of the gains came from NVIDIA, and that's about it. So if NVIDIA goes down, it takes the whole market down with it, just by the weight alone. Now, the dollar, like I said, not really making a major move today, flattish, but we see the Chinese names moving higher. We see internationals going higher. We see the EWZ, commodities heavy, also moving higher. EWW is the Mexico ETF, was a gainer today, so some optimism here that maybe the tariffs against Mexico will be delayed even longer. And with a recovery in the peso, folks at least unwinding some of the bets that they did Monday against the peso, and that's moving EWW higher. On to commodities. What do we see here? Despite the massive drop that we've seen in energy stocks today, the prices of crude did not move by much. They were down, but not down by much. Under 1% apiece for both the WTI and Brent. The gasoline RBOB was actually higher, even though the refiners pulled back, so there could be a little bit of a disparity here and an opportunity to pick the refiners if gasoline RBOB continues to go higher. Same goes with heating oil, up 1% or so for the day. Nat gas fractionally higher. Looking at softs, cocoa down about 5%. Notice that cocoa been going down for a few days now. So you see Hershey's today doing pretty good. You see Mondelez doing pretty good. So now at least you got a cocoa trade in Hershey's and Mondelez. We see cotton futures flattish, OJ down, just like yesterday, down about 1%, but coffee, no stop inside here, folks. Up yet again, 1.25%. In lumber, we're going to revive the fears of Canadian tariffs because they're only been delayed. They're going to come back later. So lumber up about 2% and sugar just down a tick, a little over 1%. Even though the dollar did not move by a lot, we see metals pulling back across the board. In the case of gold, silver, I think it was a case of overbought in the technicals. But you got Dr. Copper, the most reliable indicator for the dollar. That's up, so it is still betting that the dollar is going to go down. We'll see what happens in tomorrow's session. But grains doing a lot better. We see positive gains led by wheat. Wheat is up about 3% for the day. So I want to show you this right here. Why did I flip to being bullish on wheat? The chart that you're looking at right now is corn futures in yellow and then in red, wheat futures. There is a great degree of correlation. So when I saw corn futures moving higher, but wheat being static, as I'm highlighting in the chart right now, I saw that as an opportunity for wheat to catch up with corn, and so far, so good. Moving on to the options market, the big casino, what do we see here in today's activities? Again, the volume is down across the board, folks, with the exception of some names. NVIDIA, Tesla, Palantir, Amazon. Palantir, by the way, got a little bit of a squeeze today, gamma squeeze at the end, because there was a last-minute stampede on the 110 calls with the expiration date of tomorrow. So I expect another major move in Palantir in tomorrow's session. Could be up or down based on the change in OI, which the market maker, by the way, will spot before you and I can get an opportunity. But if the change in OI that happened today is the calls being booked and they're flipping to the puts, you'll see Palantir pulling back in a big way too. So I expect volatility here. I expect the IV rank of Palantir to increase dramatically. And NVIDIA remains at 50, so relatively cheap-ish. If you want to bet to the downside, the upside, you still got a little bit of an opportunity here in NVIDIA because I think that the IV rank is about to head much higher. Tesla at 24% of the IV rank, that's an opportunity in my book. And I think if you want to bet up or down, it's up to you, but especially if you're going to bet for more declines in Tesla. With the alarming data that we got so far from Germany, France, Norway, and California, you got cheaper put options than at least, let's say, 2-3 months ago. Which, by the way, means if you own shares at Tesla, you got to use the opportunity to hedge here. AMD, same thing, 17%. So if you think we have more downside for AMD, you'll get cheaper options than a few days ago. And if you're a shareholder, it's a good time to hedge. Looking at the call to put ratio, there's still bias toward the calls. We see a little bit of demand toward the puts today, which could be a leading indicator for an upcoming pullback as soon as tomorrow. Now, I want to show you this. The CBOE gave us data about value of options premiums traded last week, just to show you the insanity. We're talking about a little under $20 billion in NVIDIA options, a little over $10 billion, billion in Tesla. You can see all of these names, and it seems that the traders are just programmed like zombies to just continue to buy calls and assume that this stuff will go higher with all of the problems that we got. So they're succeeding in keeping these stocks elevated, by the way. They're succeeding via using billions and billions of dollars in buying call options. They're succeeding in keeping a mechanical bid underneath these stocks. But when you peel the onion, look at the financials, look at the fundamentals that we got, you got to remember the weighing machine is coming. And the results are not pretty good for Alphabet, Amazon, Microsoft, Apple, Tesla. We'll see what happens with NVIDIA. Meta, the results are okay, but we talked about the problem with CapEx. Let's move on to some of the unusual activities that we got today. Really interesting ones. We begin with CROX, Crocs. This is a bull call spread. Somebody bought the 105 calls with the expiration date of February 21st, 2025. And they sold the 120 calls, same expiration date, spending about $1.75 million. Now, this name is going to report earnings, I believe, next week. So this is sort of an earnings play. When I look at the chart, though, I don't understand why they're buying the 105, they're selling the 120. I look at the chart, and the technicals lead me to think that if we lose 95, the stock is going to flush down because it's going to play a topping in the shoulder. So it doesn't look good to me, but again, earnings, that's a fundamental catalyst. Technicals, that's a different catalyst. So you can look at the technicals, but then the fundamentals comes out differently, and we see the stock reacting to the fundamentals, not to the technicals. You got to remember the hierarchy of what the market looks at. We talked about that in details during last year's videos. We talked about the market has three drivers: the fundamentals, mechanics, and technicals. And they shift in the hierarchy from day to day, week to week. Then we got Meta calls. Again, they continue to buy calls of Meta, 715 calls this time around for the expiration date of next week, February 14th. Spending about a little over $1.25 million. We got another one here for Eli Lilly. The name reported earnings today. It moved higher, so somebody's betting on the 900 calls, which is, by the way, a closure of the gap if you're looking at the chart. So the gap that we have is a little under 900, but if you go to 900, that's going to close the gap. This is the base assumption right now. But the fact that they're going with the expiration date of June 18, 2026, it shows me that this is probably an investor, maybe a Congress kind of trader, who knows. But they want to own the stock, yet they're not sure about buying the stock up front. So what they're doing right now is buying these call options longer dated, and they assume that Eli Lilly, based on the report that we got today, will be well above 900 comes the year 2026. And if it's not, then they only lost the premium that they paid for the call options, not the entire investment, or let's say 20-30% of the investment, which could have been a lot larger. Anyhow, next we got Uber, and we got the results from Uber yesterday. We'll cover those, by the way. Again, we'll cover them over the weekend. The name went down initially, then it recovered as we digested the report. And here we have a trader who bought the 77.5 calls for the expiration date of Jan 16, 2026. Again, longer dated, paying about $1.25 million. Now, when I look at the weekly chart for Uber, we still got 1 day left for the week, but if we close like this, it looks to me as a bullish engulfing candle. But then I look at the weekly MACD, it looks as it's done playing bearish momentum, ready to flip back to bullish. So I do agree with the trade. I'm probably not going to go to 26, but if you want to grab some calls on Uber, I think the weekly chart supports you right now, at least right now. We'll see what happens. We still got 1 day left for the week. Then we got a bullish bet here on China, KWeb. Somebody bought the 39 calls for the expiration date, September 19, 2025, spending about $1.25 million. I agree. I think that China is a hot story for the year, despite the tariffs, despite all of the threats. I think China tech, really important, China tech will be pretty good because of the AI narrative. Then we got Tesla, the souffle. Somebody, look, this is going to make a big move by next week, in my opinion. We talked about the IV rack at 24, meaning the options are cheaper. I want to use it as an opportunity to anticipate this next large move, which the trader right here is anticipating will happen by next week, because I think this is the same trader, by the way. So you see that in a minute, but let's start with the calls. They bought the 387.5 calls for the expiration date of next week, February 14th, 2025, spending about a little over $2.25 million. But they also bought the 365 puts, the same expiration date, the 14th, spending about, once again, $1.25 million. In other words, you combine these trades, you have a strangle. Somebody believes that we have a really major move coming in Tesla next week or by next week. And they're playing that via strangle, buying both the puts and the calls with similar quantities. But of course, if they're spending $2.25 million in the calls and they're spending $1.25 in the puts, they have a slight bias that the move will be to the upside. We got another bearish one for you here for the Qs. Somebody bought the 522 puts for the expiration date March 14th, 2025, spending about $2 million. And then we got SoFi. we covered SoFi not so long ago, and now somebody's betting it's going to go down. They bought the 10 puts, the expiration date June 20, 2025, spending about $1.6 million. And then we have UNH, United Health, of course, the Luigi problem, maybe that's behind us now, but somebody says, nope, we're going to see bad results because they have to change, and the change means a change in their financial results too. So here they bought the 470 puts for the expiration date of August 15, 2025, spending about $1.5 million. And lastly, got another bearish one for you here for BG, for Bunch. The name is down big today because of the report, and somebody's betting we have more pain to come. They bought the 62.5 puts for the expiration date September 19, 2025, spending about $1.4 million. Now, when I look at the chart, I say it's oversold in the short run, and it's gapping below the lower bands. So I think maybe the initial reaction will be a rebound from a trading perspective, and then maybe the trader is going to be right, that it's going to head further to the downside. But at least right now, I anticipate a rebound in this name. It looks really oversold to me. Let's do the charts and then wrap it up. We begin with the most important indicator, the VIX. What do we see here? I'm highlighting the wedge pattern, falling wedge patterns in the 2 hours chart. You can see here that even momentum in the MACD is about to turn positive. We're trying to get out of this wedge right here, and the chart tried at least during the session. I think it could do it on a, let's say, an outlier in the jobs data or some volatility from OPEX, and we see a revival in buying the VIX again and hedging. Why? You got to remember, in a trade war dynamic, you never know what's going to happen over the weekend. So we see dump the VIX Fridays, crush the VIX Fridays, being reversed, as in buy the VIX Fridays, because you never know what's going to happen over the weekend. Might be another tariffs against China or Canada or Mexico or EU being announced. Looking at the E-mini futures, we're not going to do the hourly for the SPY or the daily because you already know what's going to happen here. Unless we cross below the 50 on the daily, we're not going to take any action to the downside. What matters here is the E-mini futures. You got to remember, base assumption is we hit the resistance line right here. If we don't, then we can look at, okay, are we going to reverse right now before hitting the resistance line right here? If we do, confirmation, we got to lose the 50 in blue. If we close below, okay, I'm with you. Now we got a confirmation. We have a series of lower highs and a series of lower lows, which means that at least we go down closer to 5,900 in time. The NASDAQ futures, what's important here? NASDAQ is a little weaker because of the performance of the big caps. So you see this reversal candle right here. The highs was, let's say, 21,966. We'll call it 21,970. You got to close above that wick, because if you don't, this could be all in all sort of a rising wedge pattern in the Qs. And with Amazon being weak tomorrow, it might impact the larger names, big cap tech, negatively. We see the rising wedge taking the chart back down. If it does, we want to wait for a close below the 50. Once we get that, we're going to go with the 21,000 puts and probably going to sell the 20,000. So you're going to have the spread of the 21,000, 20,000 for the monthly expiration of March. That's going to be my trade. The Bitcoin Apple, what do we do here? It is still under the 100 days moving average. A lot of you said, hey, Mav, this is probably a bear flag pattern, and down we go. Maybe that's the case, but you don't have a confirmation yet. You don't have a rejection, a bearish engulfing candle off the 100. Right now, the assumption is momentum firms up until it goes negative. So once we see the momentum in the MACD going negative, that's your confirmation to go with probably the 225, 220 puts right now and take it one step at a time. In the case of NVIDIA, what's important? What's important is the 200 days moving average. We're still above. And if we plug in the Bollinger Bands, closer to the 20, getting really close to the 20. 20 is not going to be really important right now unless you gap really below the Bollinger Bands or above. Then it becomes relevant. So it could be resistance in tomorrow's session if we continue to see this theme of the asset managers going back to NVIDIA. And right now, the 20 is setting at 130, 155. On the other hand, if you see any sign of weakness right here, when do we pull the trigger and buy some puts on NVIDIA? Once we lose the 200 days moving average, which is sitting right now at 123.27. The second indicator is bond yields. I love to look at the 30, and the 30 now giving us confirmation of the topping in his shoulder. Question is, when do we find support? My 2 cents, if I grab here a line, I would take the lowest reaction here, this consolidation pattern that we've seen here, from which, by the way, we've got a breakout. So we take the low, just to be conservative. How far low can we go? The number would be 566 basis points. So that could be support. We can find support right here and rebound higher, sure. That's a possibility because there are other minor supports from the WIX right here. That could be the point where we see a rebound in bond yields from. But right now, it could be shaping as maybe a bear flag. And we hit all the way down to that support right here, then find maybe a reliable point of a rebound in bond yields. And if that is the case and we see a rebound in bond yields, then the risk-on segment will not do pretty good, like the RTY. For now, it's it's above the 50, so it's doing pretty good. Retested the 100. So far, so good. If it loses the 100, I'm interested in buying puts, and I'm going to go all the way down to 2200 on the RTY. And by the way, if we see a breakout here in the RTY, suppose this is a bull flag pattern, and then higher we go, and I see confirmation in bond yields heading down, breaking that support that I just showed you, then I'm going to go with the 2350, 2400 call debit spread. And again, the expiration date can be the 21st, but I'd rather go to March just to be safe and have a little bit of time for the trade to work out. In the risk-on segment, what about the XHB home builders? Right now, it appears that maybe we got support. It's trying to build some bull flag kind of formation right here. But as you know, this is, of course, bond yield dependent. If we see the 30-year rebounding, then we're probably going to head back down, retest that support. I have it at 104.17, but the reaction was 104.31. So we're close enough. We'll find some support right here. If that support is not going to hold, then we have to go to the weekly chart. And you'll find out that we're probably going to break to the downside and maybe topping in the shoulder pattern. At that point, we're talking about a lot of pain. But one step at a time, folks. The risk on that I do like, although it doesn't make sense, but from a technical lens, it does make sense. If you think that bond yields will continue to go down, then you have a cup and handle here, the KRE regional banks. It's above the 50. It's not overbought. So in theory, this could continue to go higher. Of course, the risk is that this is a reaction of sort of a rising wedge, and we see jobs data causing bond yields to go higher, and we see the KRE flushing down. That's the risk, so you have to wait till we get a confirmation of the jobs data, and then make a decision. If you want to go with the risk on, maybe the KRE makes more sense than the small caps or the home builders. In the risk-off segment, the dividend-paying stocks, I do like the IYR a lot better than the XHB, because XHB is risk-on. IYR is still risk-off for now. It's above the 50, doing pretty good, so if you think that bond yields are going to go down, then IYR could be a better option to follow. XLP, same thing. You got the inverse on his shoulder, now heating up a little bit, but it closed below the 50, which I don't like. I'd rather stick with my boy here, Procter & Gamble. If we think that bond yields are going to go down, then you probably want to stick with, it doesn't matter which one you like, but I think that Procter & Gamble is more reliable than the rest, the food companies, for example, and it has also the heaviest weight in the XLP. So it could be a more reliable bet if you want to avoid the weakness in the food producers, or tobacco might pull back, or liquor might pull back. So the XLP can be more diverse than needed. So in this case, I would stick with Procter & Gamble. Now on to the third indicator, the dollar. What do we do here? Below the 50, now showing a little bit of weakness, but of course, it depends on the jobs data tomorrow. Now suppose the dollar flushes down. That's going to be an opportunity to go with the dips that we've seen in metals today. Not a lot of them dip, but we see the agricultural names dipping down. And the question now becomes, what happens if the dollar goes higher? The dollar goes higher, then you look at gold. Gold futures continue to move up, but they're kind of overbought here. They're kind of too hot. I'm going to put two and two together and say that we're probably going to see a rebound in the dollar tomorrow and a pullback in gold. What do we do with crude oil futures? Maybe finding some footing. You see the wick here, the reaction, and we're maintaining that support. It's still a bear flag, by the way, within the head and shoulder. But is there a little bit of a hope that we can see a rebound in crude oil futures? I think this is as good as it's going to get from a point where we can find a rebound. So if you're going to go take a shot on crude oil, I think that tomorrow's session could be at the point where you got to pull the trigger and buy some calls, or at least go long crude oil futures. If we break support, if we go down below this wick, which is right now sitting at 70.67, we take that number out, then forget about it, cancel the trade, because we're probably going to head lower. Any update on the Chinese names? Not really. We're still in this consolidation pattern in BABA, but if the dollar goes down, the assumption is we break and we move higher. If the dollar goes up, as I'm maybe anticipating here, you'll see gold pulling back. You'll see also the Chinese names pulling back a little bit. But so long as we're still within the pattern, the consolidation pattern in BABA, we're good to go. What do we do with Tesla? Tesla getting closer to my number, 360, the next support that I see. A little bit weaker here in the hourly chart, but I got to remember, Tesla's really active in the options market, and maybe we got a lot of puts that made a lot of money this week. They're closing those, and we see, of course, Thursday's session, a lot of the retail traders begin to buy calls in Tesla with the expiration date of the next day. And what happens is if the puts are closed and the calls are opened, you could see a mechanical reaction to the upside. But even if that happens, and maybe it is supported by this candle right here, because you see the topping candle, maybe a bottoming candle and a rebound a little bit in Tesla. But I think if we stay like this below the 50 days moving average, sooner than later, we're going to go down to fill this gap that you see right here. And the close was 320. So we'll be back to the 320s, 330s if we continue to trade below the 50. So let's see what happens tomorrow. If there's a rebound, then there's a failure. You probably want to double down. And the number would be here. The low of this wick would be, let's get closer so you can see it. It's 363.18. 18. You lose that number, you probably want to pull the trigger and double down on the shorts against the souffle. Anything to see here in Bitcoin? Not really. We're still within the range. We're probably going to flip to negative, but I think that's only going to happen if we see the market heading down. Because if the market heads down, then we're going to free up some capital in Bitcoin. Margin calls begin to hit. So I think that if we see the market beginning to head down, it's going to lead Bitcoin to a negative reaction. And then Bitcoin becomes a leading indicator to the market. If we continue to see outflows out of Bitcoin, that's going to be an ominous sign for the market because it's going to be a risk-off kind of signal. Right now, Bitcoin is not saying anything. It's just consolidating in a range. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We talked about the jobs data. That's going to be the most important catalyst. But then we have also wholesales inventories. We have the preliminary reading from the University of Michigan regarding consumer sentiment. That's going to be really important because it includes inflation expectations. We also got data for consumer credit. That's going to be really important about the health of the consumer. On top of that, we got a bunch of Fed zombies that we haven't heard from for a while, such as the demon from Minneapolis, Neil Kashkari. We got Goolsby from Chicago and Bowman. They've been talking like parrots for the last few days. Anything on the earnings calendar that we have to keep in mind? Not really. We have some names, of course, but no major names. So tomorrow is going to be all about OPEX, the jobs report, and the technicals. OPEX, of course, not the monthly, but the weekly. Given the fact that we got major moves in the morning, Monday, and then a rebound throughout the week, I think it's going to be important from a mechanical perspective, but we're going to begin with the fundamental catalyst first, which is the employment data, and then we're going to worry about OPEX. So the game plan right now, we're going to get the initial reaction by the jobs data. I'll give you a morning brief, then we update you on the options gamma walls, and we'll make a decision at that point. If we're going to see sort of a gamma up or down, we'll play it that way if that's the setup that we're going to see. With that being said, thank you folks for joining us tonight. Hopefully you found the show informative, but this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Engagement sans monogamie. Lève-toi, approche, et sois gentil. Rien n'est dit, mais il y a ce mot. Apparence trompeuse, c'est le sous-audio. Si tu fermes les yeux dans cette ville de métal, excitation, ultime pas commercial. Regarde à travers la glace.